Hey, so Vanguard's come out with their market perspective update. This is as of October of this year. Pardon me as I stick this in my face to read some of my notes from their report. What's interesting is their asset class return outlook. So this is looking at U.S. equities, value stocks, growth stocks, small cap, real estate. So for U.S. equities overall, so this would be like the S&P 500, they're projecting a rate of return of 4.1 to 6.1% annualized over the next decade. They're also showing about a 17% volatility off of those numbers. Value stocks, which are been doing fairly well this year relative to everything else, they're still showing up 4.4 to 6.4, so maybe a little outsized growth in value, but they're showing more volatility in that as well at 19% above and below those averages. U.S. inflation, this is the first thing I went to, is what were they looking for U.S. inflation going forward? Because as planners, we need to know how to prepare our clients for inflation in the future. They're showing a 2 to 3% inflation rate over the next 10 years, deviating off of that, but maybe 2.4%. So even at 5.4%, we're still above that currently, which indicates to me that Vanguard sees this as being somewhat temporary. As far as economic growth, the second quarter of this year was revised upward, but not enough to be positive. So we're still negative growth at negative 0.6% in the last quarter. Right now, we're looking at economic growth being positive at the end of this year by 0.25 to 0.5% range. Obviously, that's not really good. We should be growing between 2 to 4%. 4% would be obviously pre-COVID growth rate. Looking at oil prices over the next, in the short term here, $130 to $150 a barrel range is what they're predicting. They believe that there'll be no recession this year. So right now, they say there's a 25% chance of a recession in 2022. As of September 12th, the 10-year and the 3-month Treasury yields were not inverted. Sometimes when short-term Treasuries get higher than yield than long-term Treasuries, then that is a signal of a recession pending. But in this case, they don't see that happening. However, for 2023, they're still showing a 65% chance that the U.S. is in a recession. What's interesting is just because you're in a recession doesn't mean the stock market's doing poorly. The stock market runs about 6 months ahead in trying to predict the future. So once a recession has been called, typically the stock market will begin climbing out of that, depending on how deep the recession is. Rate cuts in 2022 are unlikely. We think we all know this by now, but they're also saying rate cuts in 2023 are unlikely, because people are getting paid more, people are seeing wage increases, and they're also, we have a very low unemployment rate here in the U.S. right now. I think there's still 2 jobs for every 1 person looking right now. This means that the Fed possibly will have to continue to inflate interest rates beyond their target, which could be more pain ahead for the stock market here in the short term. Ultimately, all these are predictions that none of these are, I would say, none of these are contrary to what all the other major economic reports are showing from BlackRock and State Street and the other big firms. But ultimately, I do like to look at it at least once a month when they come out, so that we just have an idea of why things are happening the way they are. Will the stock market continue to fall? I don't know. There's a bottom in here somewhere. We've come down a long ways from our highs, but ultimately we're not investing for next year. We're investing for the rest of our lives. How long is that? We don't know that final day, obviously, but ultimately for our clients, we're planning to age 95 to 100, and we build our portfolios with that long-term view. In the short term, a lot of this is painful noise right now. So ultimately, you probably shouldn't be watching this. You should be working or doing something that you enjoy. Focus less on this, more on things that bring you joy. Thanks for watching.